Good evening. My name is Linda Yu, and it's my pleasure to chair this panel with a slightly ominous, but I'm sure it's going to be a stimulating discussion as to whether we are facing a new round of financial crises in emerging markets. It's going to be, I'm sure, a lively hour. So just a couple of housekeeping things before I introduce the speakers. The very first thing to say is I'd be ever so grateful if you could put your mobile phones on silent. I'm not asking you to turn them off, just on silent. And in fact, I'm going to encourage you to tweet during the session, if you like, using the hashtag #CHEvents. And it is on the record. And on top of that, we're actually being live streamed. So hello to all the audience out on the internet as well. So we are going to hear from each of the speakers, and then there will be a discussion on the panel, followed by, of course, questions from all of you. So that will take us to 7 p.m., at which time we will conclude the panel. So let me just properly introduce the panel, the topic a bit, and then I'll turn to each of the speakers who will be answering this question as to whether or not we are facing another financial crisis in emerging markets. Obviously, right now, there are growing tensions around emerging markets. The International Monetary Fund has extended precautionary lines of credit. So a lot of the concerns around what might happen is already, I think, bubbling around in the global economy. And this is a wonderful opportunity to hear from a panel of experts around how we should think about the potential of a financial crisis in emerging markets, and generally about how emerging markets are faring at a time when some of those financial market pressures associated with a strong dollar, associated with capital movements, are again issues that they need to think about. And then, of course, how emerging markets fare are a growing part of the world economy, and therefore how they fare will impact all of us. So I'm delighted to have this great panel here to answer these questions for you this evening. To my left is David Lubin. He's the head of emerging market economics at Citi. He's also an associate fellow here at Chatham House in the Global Economy and Finance Department. To his left is Dr. Jing Gu. She's the director of the Center for Rising Powers and Global Development at the Institute of Development Studies at the University of Sussex. And then to her left is Dr. Robert Faulkner. He's the research director of the Grantham Research Institute on Climate Change and the Environment here, as well as Associate Professor of International Relations at the LSE. So one book plug, and then we'll get to the panelists. David has written a book called Dance of the Trillions, Developing Countries and Global Finance, published as part of the Chatham House and Brookings Institute Insight book series. I highly recommend taking a look at the book afterwards. And of course, there'll be a reception after this panel where you can ask David all about the book and the tremendous work that he's done on the back of it. So I'm just now going to turn to each of the panelists to give a few opening remarks about this issue of whether we are facing a financial crisis in emerging markets and so how we should be thinking about this topic. So, David, the floor is yours.
Thank you very much, Linda. Let me start by asking, why are we asking this question? Are emerging markets facing a new round of financial crises? It's because since April, there's been a fairly measurable round of capital outflows from developing countries. This is not a new phenomenon. Outflow episodes when capital leaves emerging economies is something that we've got used to over the last 40 years, since Poland defaulted on its debt in 1981, and even before. And we know, well, this episode of capital outflows has already had some quite nasty effects. As Linda mentioned, Argentina, having faced a 35% depreciation of its currency, having tried to defend its currency with 1,000 basis points of rate hikes, couldn't prevent capital from fleeing further, and then had to negotiate a $50 billion standby facility with the IMF. The Turkish lira has depreciated by 20% and has had to raise interest rates by 500 basis points or so. Central banks in Mexico, in India, in Indonesia, in Pakistan, in the Philippines have all had to raise interest rates. The Central Bank of Russia, the Central Bank of Brazil have been prevented from cutting interest rates further in order to stop capital from flowing out in even greater quantities. Why this is happening is exactly the same reason as it's been happening periodically for 40 years. It's a tightening of US monetary conditions. US monetary conditions since the 1970s are the overwhelming force that shapes the push and pull factors governing capital flows to emerging economies. When US monetary conditions are loose, that tends to push capital towards emerging economies, and when they tighten, it tends to suck capital from them. The problem is that saying US monetary conditions is a very broad concept. So I can say pretty confidently that US monetary conditions determine capital flows to developing countries. The problem is that we never quite know at any one time which measure of US monetary conditions counts. Sometimes it's the Fed funds rate. It's what the Federal Reserve does. Sometimes it's the 10-year bond yield in the United States. In 2013, during an episode very famously known as the taper tantrum, the only measure of US monetary conditions that was relevant in shaping the market's risk appetite towards developing countries was the US 10-year yield. Sometimes it's neither the Fed funds rate nor the 10-year yield, it's the dollar exchange rate. And that's where we've been in the last couple of months. It was an appreciation of the dollar that caused this capital outflow rather than anything happening to the US yield curve. This isn't the first time when the dollar has been the most important kind of measure of US monetary conditions as it governs capital flows. For example, in the run-up to the 1997 Asian financial crisis, barely anything happened to US interest rates. The measure of monetary conditions that was relevant in precipitating the Asian crisis in 1997 was an appreciation of the dollar. Frankly, it's a mystery which measure of US monetary conditions is relevant at any one time. I don't know how to explain that or how to explain why the market changes its view from time to time about which measure of monetary conditions is relevant. It just happens. It's just one of those things. As we know, what's happened to Argentina you can quite confidently describe as a financial crisis. And if this was the 1980s or the 1990s, I think it would be possible to predict quite confidently that what just happened to Argentina would be spread broadly across the emerging world, that crises would multiply as a result of further tightening of US monetary conditions. But actually, it's quite tempting to argue that we may be in a kind of post-crisis world for emerging economies. And the reason for that is that the vulnerability that characterized developing countries in the 1980s and 1990s, which gave rise to this 2-decade-long time span of intermittent financial crises. If I generalize, the two central vulnerabilities that existed in the 1980s and 90s was A, that many developing countries had fixed exchange rates. In other words, their exchange rate was not available to absorb shocks. And B, developing countries during those 2 decades had very weak balance sheets. Now, the concept of balance sheets is a very complicated one, but maybe the most sort of important concept within that is that they lacked foreign exchange reserves. In other words, they lacked dollar resources that they could use to withstand the volatility of capital outflows. In the 20 years since the Asian crisis, or rather the 20 years since the Russian crisis in 1998, or the 17 years since the Argentina crisis in 2001, emerging economies have made strenuous efforts, driven in many ways by the trauma of what happened to them in the 1980s and 1990s, to eliminate those two vulnerabilities. So what you see now is a prevalence of floating exchange rates rather than fixed exchange rates, and a continuous acquisition of foreign exchange reserves. So the two central vulnerabilities that existed in the 1980s and 90s are rather uncommon these days. And it's because of that that I think it's at least tempting to argue that things have changed. Now, it sounds like what I'm saying is this time is different, and you should be very nervous of an economist when he says or she says this time is different. Whether it's different, I think, depends a lot on what happens in China. China has played a role in reshaping the economic lives of developing countries over the last 20 years. First, by delivering a boom in commodity prices, the like of which the world had not seen for 200 years. And secondly, since the global financial crisis in 2008, in using its strong balance sheet to finance stimulus policies which have supported Chinese growth and therefore helped to support the growth rates of a number of developing countries. The credit expansion on which China's stimulus was based may not be survivable for a long time. And so China's positive, benign influence on developing countries may not be sustainable. To put it bluntly, if China itself is going to face a crisis, then a lot of other countries will too. China's also become a more important source of influence on the economic lives of developing countries by becoming a kind of substitute supplier of funding, particularly, most famously, in the context of the Belt and Road Initiative, which was announced in 2014. But there may be constraints on China's ability to finance projects in the Belt and Road, something I don't have time to discuss, but maybe we can come back to it. If China is allowed to kind of remain as a sort of positive, benign influence on the economic and the financial lives of developing countries, then I think the point that I'm making about emerging economies being somehow post-crisis may be a valid one. But even if that is the case, if, in other words, China is able to convert the economic influence that it has on the lives of developing countries into intellectual influence, in the same way that Washington was able to convert its economic influence on the lives of developing countries into intellectual influence through the Washington Consensus, if that's the case, then the kind of policy framework, the sort of conventional thinking about how developing countries should manage their economies could change dramatically, because the central difference between a Washington Consensus and a Beijing Consensus is A, that the Washington Consensus places primacy on the role of markets, whereas China thinks very differently about the correct balance of power between markets and the state. And secondly, that China thinks differently about the relative balance of power between what I call rules and discretion. What we've lived through, 30 seconds, sorry, what we've lived through is one of the characteristics of the Washington Consensus that's governed the economic lives of developing countries in the last 30 years, and which governs the flow of capital to emerging markets, is that it is rule-based. The rule is you should keep your capital accounts open. You should let capital flow out willy-nilly. China rejects that. China emphasizes the role of discretion, the idea that the policymaker should have discretion to decide which kinds of capital flows are good and which kind of capital flows are bad. So along those two contours, I think we could actually, in any case, see the economic policy framework under which developing countries manage themselves change considerably over time.
Thank you very much, David.
Sorry,
okay.
so long.
I'm just going to make sure we all end up getting out of here in time for drinks
Yes.
at 7. That's the priority. No, now let me turn over to Dr. Jinggu for your take on the issue today.
Thank you, Linda. Thank you, David. I think to some extent, David said what I want to say. But yes, I think you raised very important questions in your book about whether China is willing or be able to convert its economic power to the influence on the policy framework in the other developing countries. That's a very interesting question. My response to this question actually very positive. I think, when you, because I work on international development cooperation issues, when you look at the global development in the last 20 years, we witnessed a dramatic change in the global development landscape, especially in recent 10 years. China is becoming an increasingly important actor in global development, which we never imagined, like 20 years ago. Taking China and Africa as an example, China is Africa's largest trading power, and China has more than 3,000 companies across 50 African countries. And according to some statistics, China has nearly 1 million, basically 1 million Chinese working in various African countries. Apparently, but China is not just a financial power in many developing countries, but a power of ideas and knowledge, especially its development paradigm, its development model become increasingly very attractive for many African leaders and also the leaders from other, developing countries. So I think, my answer is definitely yes. China is playing a very important role, not just in terms of hard power, but also the soft power, the ideas and how to do development, how to develop your economy, how to manage your economy. Like you mentioned, the capital mobility, apparently China, to some extent, is harmful to have a free capital movement or free capital flow in and out of the countries, especially for developing countries. I think given China's last 20 years experience, the liberalization of the capital account is very limited. And also, but we don't know what the future holds, especially with the internationalization of the currency, the renminbi, and also China's ambition to become the real power in global development. So it's a difficult question what the future holds. But I also want to raise a point about the reform of the global financial governance. In my view, at the macro level, the global financial governance is in crisis. We do not have a valid, or legitimate or institutes, who can design the macro level international monetary policy and also the trade policy, etc. The global financial system basically has grown in an unplanned way, and the institutions are ad hoc, patchy, often reflecting national rather than global interests. And also can only influence those in trouble. So the global financial institutions certainly needs reform, but this should be whose initiative? It's a question mark. The initiative very much naturally should come from the emerging markets. But the emerging markets, we have to differentiate the emerging markets. China is very different from Argentina, from Turkey, etc. They have different national interests. So the future of the reform of the global financial institutions will be very interesting. And we have to see, what's the plan from the emerging markets. And my last point is actually on this important Chinese initiative, global and regional initiative you mentioned, like the Belt and the Road Initiative, and also the AIIB Bank, Asian Infrastructure Investment Bank. So up to now, more than 70 countries joined the AIIB, and most of its capital is provided by emerging and developing governments. It will reflect this development experience of these governments. And also, it has incorporated many developing economies into its membership. The authorized initial capital stock of the AIIB Bank is about $100 billion, about 1/3 of the World Bank. So the board of directors will function on a non-resident basis. In 2016, IDS research team had a meeting with President Jin of the AIIB Bank. He mentioned that the AIIB expected to lend between $10 to $25 billion during the first 5 to 6 years. And also, my colleague Stephanie Griffin-Jones' calculation is in 2025, the total level accumulated loans by AIIB could reach $120 billion. And the total stock of infrastructure lending of the AIIB in 2025 could be significantly higher than the World Bank stock of infrastructure lending. If it co-finances with private funders, World Bank and also Asian Development Bank, the AIIB could reach well over $120 billion, up to $240 billion. So, but my point is not about the financial power of the AIIB. To me, very interesting, we need to watch the development of AIIB in the next 20 years. AIIB is not just about finance, it's not just about money, but about knowledge, how to do development. So my confidence with the AIIB is actually lies in its perhaps another identity as a knowledge bank. So I will end up here.
Thank you very much. Robert, over to you on your take on this issue about a new round of financial crises and emerging markets.
Thank you, Linda. Thank you for having me here. May I take the opportunity to start with a comment on the book, since it was introduced at the beginning and we didn't really touch on it too much. I read it, I enjoyed it hugely. It's not just deeply researched, sharp in its analysis and quite provocative in its conclusions. It's beautifully written. And how many monetary policy books do you know that are in that sort of category, right? So my only disappointment is there are not enough copies here to buy the book today. So that's my main complaint. But apart from that, all I can say is don't miss out on that opportunity. It actually reminds me, the book, of a senior scholar who no longer is with us, who worked in a similar field and also spanned the two institutions where I have hats to wear, Chatham House and LSE. That's Susan Strange. Some of you in the audience might remember her work. She wrote similarly perceptive books about the inherent instability of global financial markets. She wrote them at the LSE. Her famous book, Casino Capitalism, in many ways predicted the financial crisis. But she started out writing on global finance here at Chatham House. And so your book is in that venerable tradition, and I hope it'll carry on in that way. So much for the plug. Okay, I'll stop there. Now, what about the looming financial crisis? I don't want to add too much to what David said because you've laid it out. It all starts in the US, rising interest rates, the rising dollar, the withdrawal of liquidity in the US is all going to have ripple effects around the world, and particularly in emerging markets. That's the formula that we're familiar with. But I want to mention just a broader context to this, and it's not just contemporary issues in US monetary policy or even Trump's trade war, which we probably need to touch on here. But it goes back further. It goes back at least 10 years. And that's the post-financial crisis monetary situation that we found ourselves in. Thanks to the financial crisis, we've enjoyed, if that's the right word, a good decade of relatively abundant and cheap money. Quantitative easing has pushed money out into the emerging markets in search for higher yield but also higher risk investments. And that, of course, is now looking a bit shaky as quantitative easing is being wound up and as the liquidity flows are drying up. So in a way, the emerging markets, I think, have had an easy run for the last 10 years. They've been blessed by the fallout of the financial crisis. So some of the volatility that's returning to these markets is not least due to the sort of post-crisis unwinding that we're starting to work on now. So I think there's nothing unusual about the rising volatility that we expected. Now, what about those four words that you used? I think in the book you described them as the four most expensive words in world history. This time is different, all right? So if you ever hear that word, run for the exit immediately. But what is different? So you mentioned currency fluctuations. So within a more flexible currency exchange system, it should be easier to adapt. You mentioned the hoarding of foreign currencies as a buffer. That is all good news. problem is we haven't really tested it, and we're not quite sure which of those countries are likely to rely on that successfully and which aren't. So there's some uncertainty around that. Capital controls. Again, there's now a much more liberal as in free approach to using capital controls. It's almost the opposite of the Washington consensus that had existed so far. And again, we haven't put them to the test yet. China has demonstrated how you can shield yourself against financial instability. But of course, China is a very different player in that field and has its own unique characteristics that many other emerging markets can't replicate. So I'm not convinced yet that this time is different indeed, because I'm not sure we've put these new mechanisms to the full test. And so we are probably going to run a good social science experiment. And as often in social science research, others will pay the price for it. The last point, and I'm aware I need to come to the final point, brings me to China and China's role. And in the book, David, you talk about how the Washington consensus is receding, and I would go further, it's dead in the water. And you then talk about the Beijing consensus emerging as a potential alternative, as a perhaps new intellectual framework with China providing solutions to the world. I'm just not sure there is such a thing as a Beijing consensus. I mean, consensus means lots of people agreeing on something. There's probably more of a Beijing model, and it's not clear yet whether many world financial players will agree on that model. And I'm not even sure if there's a Beijing model either. What is it usually assumed to be? It's a mixture of a heavy-handed but clever role of the state in directing investment and managing economic growth. And that's then coupled with the idea of shielding that state-run capitalist system from external shocks through, for example, the use of capital controls, your discretionary method. Fascinating model, but I can't quite see how you will solve emerging markets problems by telling other countries do the same and do more of the same. It takes a lot. It takes a very capable state. It takes a very focused state, and not the kind of state that we usually observe in lots of emerging markets. And so I'm not quite sure that that is going to be the sort of the recipe that will unlock these political dilemmas that these countries face. So I think there are other measures needed. And finally, just on China's role, if I may, Chair, one last comment. Yeah, China is playing that huge role now. Its lending is almost on a par, and in some cases exceeding the lending that the World Bank and other Western multilateral banks are dishing out around the world. But again, China has had an easy run. So far, it's been lending huge amounts of capital in environments that are not rocked by financial instability. China has not had to deal with countries that default, that do not play by the rule book. And so China has yet to experience what it means to be the world's largest lender and then have to enforce the rules and then have to deal with those countries that behave in rather awkward ways. So in a way, it's interesting to note that China's lending institutions, the Exim Bank and so on, are starting to try and draw other multilateral banks into their own activities, not least both to spread the risk but also learn from them how you manage those potentially defaulting countries. So I'm not convinced that China is going to be the next big thing after the failure of the West. And I'll leave it at that.
Thank you very much, Robert. I'm just going to follow up with a set of questions to the audience and let you guys get ready for your own questions. I think to David, given that you operate in financial markets, what are some indicators to look for if one was worried about a looming financial crisis in an emerging market? So, in other words, you discussed it's very difficult to work out which monetary conditions matter the most. But we have some guidance through history. The early 80s, the first generation currency crisis in Latin America, the big triggers there were fiscal deficits in Latin American countries, indicators of external indebtedness. The second generation currency crisis was actually in Europe, in the ERM, and that had to do with unsustainable pegs. And George Soros selling sterling. I think we all know this story. The third generation crisis, which was a currency and financial crisis in the late 80s, the Asian financial crisis, was a financial crisis based first and foremost on cronyism and some too much money being lent, which then triggered a currency crisis. So what I'm getting at is each of these crises have to do with monetary tightening, but they all have certain indicators attached to them, whether it's deficits or too much hot money inflow. I know this time is probably not different, but what should we be looking out for in this next potential fourth generation financial crisis?
I think the analysis of vulnerability to capital outflows has something to do with what economists call stocks and something to do with what economists call flows. The most important flow indicator is how many dollars you need from the rest of the world. In other words, the more dollars you need from the rest of the world, at the point at which those dollars become unavailable because US monetary tightening is sucking them away, then you are vulnerable. That indicator is usually conventionally measured by the size of a country's current account deficit, which is the broadest measure of a trade deficit.
How much of it is covered by their own reserves?
Yes, and what obligation each country has to repay debt over the next 12 months, let's say.
Yeah.
So that's a kind of, a way of thinking about a kind of flow indicator that gives rise to vulnerability, that helps you understand vulnerability. But stocks are important too. What I mean by stocks is just how much debt you have in the first place. So, just making up an example, a country that has a large current account deficit, in other words, a large financing need, but very little debt on its balance sheet, will be safer than a country that has a same large current account deficit, but has a lot of debt. So it's that kind of, it's a sort of balance between an analysis of stocks and analysis of flows.
Great. No quick rules of thumb, 50% external debt denominated in dollars or
I wish.
anything? Okay.
There was one of many of the people who kind of failed to see the Argentina crisis coming in 2001 drew a lot of confidence from the fact that Argentina's public debt burden was less than 60%, which was the Maastricht criterion for public debt. So as soon as you think you've identified a rule of thumb, something's going to come and make it wrong.
That's a very good tip, actually. Jinggu, I wanted to get you to elaborate a bit on, you talked a lot about China's growing role. If there was an emerging market financial crisis, given how vested China is in emerging markets at the moment, literally invested in the case of African countries, would China come to the rescue of an emerging market that needed a bailout itself? So rather than go to the IMF, would China play that actual rescue role, given it's already set up essentially a counterpart to the World Bank in the AIIB? But could it play the role the IMF currently plays, but perhaps with different conditionality attached?
And I think this is really interesting question about, how will China protect its overseas investment? How should China define its overseas interests? I think at the moment, in terms of the relationship between China and other developing countries, especially the least developing countries, is very much kind of, I should put it this way, China is still in a steep learning curve. So it's not, the answer is yes or no. Yes is China is actively pursue a policy of trying to, to help the developing countries develop its economy, but also to treat them as business partners rather than the relationship between donor and the recipient. We witnessed, in the last 50 years between the North and the South. It's always a relationship between donor and the recipients. But China regards its relationship with many developing countries as very much a partnership, strategic partnership. In other words, if you're business partners, you need to behave like business partners. So I think China will try its best to help the other emerging markets or the other developing countries. But there's so much China can do itself because it's facing a severe domestic challenge in terms of how to manage its own financial risk Linda, perhaps you know very well on this. In recent 2 days, this hot debate between the Chinese Ministry of Finance and also Chinese Central Bank on the how to manage financial risks, and also can China have a valid fiscal policy? And what's the difference between Chinese fiscal policy and Chinese monetary policy? All these debates are going on right now. So I think, it's difficult to answer, but I think from China's national interest point of view, China will do its best to help the other developing countries.
Thank you. Yes, no, I think China has a lot of discussions around macroprudential regulation, how you manage financial stability on top of all the other risks that it currently manages with exchange rates and debt. And that leads me nicely, actually, to Robert for the final question. In terms of, you've expressed, I think, some skepticism around the current economic order as it stands. I suppose the question I would ask you is, if you looked across emerging economies, and we've talked a lot about the financial side, are there other triggers that could cause a crisis? Because as we know, crises can be crises of confidence.
Exactly, and there are a lot of economic factors, but also geopolitical factors that play into that. At the moment, everyone's looking very carefully at the evolving trade relationship, or is it already a trade war between the US and China and the US and the EU?
Well, talks have just broken down today, so we're getting closer to a trade war.
It's hard to keep up with developments here. But I think this has huge implications for emerging markets. They may think, who knows, that they are not at the moment in the sort of they're not the target of Trump's various trade policy measures. But of course, for many emerging markets, the last 10, 15 years were all about embedding their own companies in the global supply chains that American, European, and increasingly Chinese companies have run around the world. So there's a famous economist, Richard Baldwin, who in his book about the history of globalization writes that this was the main growth strategy, to find your niche in global supply chains. But that means this strategy of export-led growth only works if those trading relationships will continue to work in that way. And what Trump is currently doing is he's disrupting many of these supply chains, forcing back American capital and American employment back to the US, a reshoring effort which is enforced, and this will leave a lot of emerging markets high and dry in terms of their ability to insert themselves and stay engaged in these chains. So that could certainly drive down investor confidence very rapidly. So I think this is actually an unusual situation that we've not had before. Some observers point out that growth in the global economy is still looking good. China's growth rate has just been revised down again to another 6 point something rate. Wouldn't we all?
6.7.
What looks terrible from a Chinese perspective is admirable from everywhere else. So there's still robust growth around the world, and of course China's investment program in infrastructure will shore up some of that growth. But that can turn sour very quickly indeed. And that's where I'm rather worried that we will pile crisis onto crisis here.
No, it's very good. Indeed, I think that is probably one of the other big risks, which is if this trade war, if it is a trade war, starts to target investment across countries by putting up barriers, then I think that could cause some developing countries to find it very difficult to continue to grow. And that's the issue with debt. If you're growing, then the debt to GDP ratio always looks slightly better than if growth gets really hit. You knew we'd get to Trump. Now the floor is open. There are microphones which will come around. If you could please introduce yourself, your name, who you're with, and who you'd like to answer your question. But I'd be so grateful if you keep the question concise so we can get in as many questioners as possible. So the gentleman there in the white shirt. And then I see a hand up over there, the gentleman in the back row.
Good afternoon. Nick Harris from Allenby Capital. To be honest, I'm not sure who would be the best person to answer it, but question on China and its sort of stock of foreign assets. What is the proportion between maybe more conventional debt holdings and direct stakes, whether they are equity or quasi-equity?
Good question. Thank you. Okay, there's a question there.
Member and freelance marketing consultant. My question is, can the future economic crisis prevented by applying behavioral economics?
Great question, thank you. Okay, and we've got two questions. We'll take both of you. Yeah.
Thank you. I'm James King from the Financial Times. First of all, I'd just like to say, David, I read the book. I thought it was absolutely terrific and really taught me a lot.
That goes on the cover, David. That's James.
My question is, either to Jingu or to David, do you feel that the Chinese authorities think that they're kind of running short of money to fund the Belt and Road Initiative? It's just as simple as that.
Okay, we'll come to the next round in a moment. And so, foreign assets of China, debt versus equity stakes. David, do you want to take that?
Yeah. China accumulated a stock of foreign exchange reserves which reached $4 trillion in 2014 because of capital outflows. In 2015, 2016, that stock is now around just above $3 trillion. At one stage when reserves were high, and in the context of the announcement of the Belt and Road Initiative, SAFE, which manages the central bank's reserves, the State Administration for Foreign Exchange, used some reserves to capitalize a number of investment companies, the Silk Road Fund, CIC Capital, the Chinese National Investment Corporation, the China Latin America Fund. You know, there are a number of different investment vehicles. Actually, there is not much transparency about the exact amount of funds that were used to capitalize these investment vehicles, what their exposure is, or what they do. There's just not much transparency. And to save time, I'll quickly use that as a kind of segue to answer James's question, which is that if the renminbi were a properly functioning global currency, then China could just print the stuff and lend it to other developing countries. The fact is that the renminbi is not a fully functioning global currency. We thought that it was making progress towards that in the years running up until 2015, when it really seemed like there was a big increase in the amount of China's trade that was settled in renminbi. There was a big increase in the volume of renminbi-denominated bond issuance that was sold to foreign investors. It was all looking great until 2015. And that, just at that point, when China's foreign exchange reserves started to fall against the background where China's economy was slowing and people didn't know what its capital account policies were, those measures of the renminbi's internationalization collapsed. So the fact is that China has a kind of dollar constraint. In other words, its ability to fund these projects, its ability to expand its economic influence across borders, relies to a large extent at the moment on its possession of dollars. Now, as I said, A, those dollar resources have fallen in the last couple of years. B, China itself is possibly a victim of the consequences of US monetary tightening. China is another developing country. And so just as we're discussing that, when US monetary conditions suck capital from most developing countries, it will also tend to suck capital from China. Now, China has a way of preventing that becoming a big problem, which is that in 2016 and 2017, China put into place a bunch of controls on capital outflows. So that helps to kind of sever the link between your domestic economy or your dollar resources and what's happening at the US Fed or what's happening in US monetary conditions. But we don't know that those capital controls will stay as effective as they seem to be at the moment. The history of capital controls, frankly, is that when money has an incentive to leave a country, it's going to leave the country. Maybe China has a better chance of making its capital controls effective than other countries have in the past, but it's still a question. And there's a third point as well, which is that China has been running a current account surplus for as long as it's been plugged into the global economy. The only China that financial markets have had to think about is a China with a current account surplus. And yet it looks very likely that that current account surplus is going to perhaps disappear quite soon.
The first quarter was a deficit.
For the first time in 20 years. If China starts to run persistent current account deficits, in other words, it will need the rest of the world's dollars to finance itself. If it needs dollars to finance itself, that kind of means that there might be fewer dollars to go around for China to lend to other countries. So I think that there are a number of constraints on fulfilling China's objectives in the Belt and Road Initiative.
Thank you. Jingu, let me bring you in. Obviously, China's committed to spending $800 billion on the Belt and Road Initiative over the next 5 years. There's another $200 billion, which has been pledged as part of the new Silk Road Fund. Are they going to run out of money before they could fund it?
I agree. There are lots of constraints to China's investment in this Belt and Road Initiative. But on the other hand, you know, the Belt and Road Initiative at the moment we very much focus on the power of the government, of the state, of the public sector. China hasn't fully utilized the private investment and private capital. There are lots of potentials with Chinese private investors. But because, as you said, you know, lots of issues are not transparent, so we don't really know what's the potential China holds on the Belt and Road Initiative. So I think we need more evidence and more data in order to draw useful conclusions.
Thank you. Okay, so Robert, I'm going to get you to answer the really hard question that was posed: is can we prevent a financial crisis, behavioral economics, or any other way?
Well, there's a short answer to that, which is I'm not a behavioral economist, so I better be polite about my colleagues at the LSE and what they're doing. I think behavioral economics is a terribly exciting development within economics. Should remind all trained economists that there are other disciplines out there that can contribute to the discourse. I trained as an economist myself, but I'm now an international relations scholar, so I carry humility on both sides of that divide. But I think it has its uses, but I think it's also quite limited in what it can do. So it's good about understanding how personal beliefs, psychological traits, but also incentive structures affect behavior. And, you know, at LSE, they're doing work, quite some esoteric work into, for example, trading behavior in the city and what factors influence that. The latest research shows air pollution levels in London affect trading in the city. And there are lots of ways you can therefore sort of tweak or nudge people in the right direction. But we're talking here of a highly complex global system, an interconnected system where, you know, lots and lots of actors respond to each other's movements. And it would be difficult to design a behavioral economic sort of approach to fixing the systemic faults in the system. That's why I think there'll be a small contribution, but not too big one.
Thank you. There were 3 more hands, one here, the lady in front, and the hand there. And if we keep these questions brief, we might be able to get in a final round. So, please.
Thank you. Simon Kitchen from EFG Hermes. David, you mentioned that having a flexible currency, having a lot of reserves was a sort of a good policy in the face of US monetary policy. That was the best preparation. So what's the best preparation? This is for everyone on the panel. What's the best preparation, and which countries are the best prepared for an era of rising trade barriers and disputes over trade and over financial policy?
Thank you very much. And a question here.
Anquat from Citigroup Corporate Banking. I have a question for David and Dr. Jingu on China's influence. So I've come across some comments saying that the Belt and Road Initiative is a debt trap for emerging market economies with the loan-to-own approach of China. And they quote the recent example of Sri Lanka having to give up their port because they couldn't service the Chinese debt. What is your take on this?
Thank you very much. And the question there, the gentleman there.
Hello, I'm John Galani. I am the European Middle Eastern operations for an Asian-based commodity trader. I view the dollar system a bit as a gold standard, whereby the dollar is actually not a moving target. Everything else around it is. If the dollar shifts, then everything else has to shift around it. If and when we do go into the next crisis, we need to work around the dollar, as is today the case. And so with the splintering of the geopolitical structures, do you believe that any crisis would be exacerbated by the current tensions? Or is there still a consensus whereby we can get together and help each other in a way?
Great question. Thank you very much. So let's start with the best prepared EMs, David. I want to get another round, so if I may, just ask each of you to answer one of the questions.
Just on Simon's question about trade barriers, it's critically important. Emerging markets is a kind of organizing concept in international capital markets. For anyone who's involved in finance, it's an asset class. In other words, it attracts capital because there are bankers and people who sell the idea of investing in emerging markets. Emerging markets would not exist as an asset class. It would not exist as an organizing principle in international financial markets were it not for globalization. And the rise of protectionism, which is not something that was born on January the 20th, 2017, when Donald Trump was inaugurated. It's something that we've seen grow, for the last several years. Rising protectionism is a critical threat to globalization. I'm not trying to make any prognosis or anything. I'm just trying to identify the threat, because what globalization has been, the reason why emerging markets exist as an organizing concept is because there's an economic globalization process underneath the financial globalization stuff. That economic globalization process existed because developing countries 30, 40 years ago began to realize that they had an incentive to open themselves up to trade. If those incentives start to get closed down because of a rise in protectionism, that is, it's bad news for capital markets activity, but more importantly, it's bad news for growth. No, and to answer the question, I don't think anybody's really protected against that.
Sorry, I was going to get you an answer. But it is an answer. It's an honest answer. Thank you. We'll try to keep these brief to get another round in. Jinggu, is the Belt and Road Initiative just a debt trap? Sri Lanka having to give up control of its ports because it couldn't repay the funding from China?
I think it's too simple to see the Belt and Road Initiative is just a debt trap, because it's not just about infrastructure investment, but about the connectivities between the different region, different continent, and also it's about China's ambition in global development. So China, as you know, China is desperate for the Belt and Road Initiative to be a great success. So in other words, the government and also the companies and also the think tanks are trying very hard to make it a success. This debt issue definitely is on the top agenda of the government and the think tanks and the companies, so how to deal with this debt issue. And also the Belt and Road Initiative at the moment, it just started in 2015. So it's too early to say, or it's just a debt trap, or it's just a blueprint for the global development. It's too early to say. We need evidence. We need, a solid case study to prove, the benefit and the pros and the cons of this global initiative of China. So definitely more research, more in-depth research needed.
Like at your center. Robert, just quickly on the, when we had the 2008 financial crisis, obviously all the countries came together, swap lines were agreed between central banks, and you saw really the G20 acting together to promise things like not do protectionist measures and all of that. Are we in an era in which if we had another financial crisis, you could get the same level of consensual working together, collaboration?
Do you want me to keep it short?
Yes.
The answer is no. I think,
okay, you're going to have to say a bit more.
Okay, there's a bit more to that. I think we're only beginning to see the Trump effect playing itself out in a lot of different forums. And even if you think that this is a 4-year problem or an 8-year problem, and then we'll revert back to normality. I don't think that's a realistic scenario. I think the world, since the end of the Cold War, has been drifting into a much more regionalized system, but certainly in security terms, also in political terms. China, as a rising power, is unlikely ever to become a global power, is more likely to become a regional power. It already is, but I don't think it has either the aspiration or the capacity to be a global power the way the US was. So I think the long-term consequences of Trump's policies will be to reinforce tendencies in other regions, in Europe, in Asia, to go your own way, to find your own solutions, and not wait for the US to be the benign hegemon as we used to think.
We are going to squeeze in one more round because there are so many hands. There are way too many hands. We're not going to be able to do this. So I'm just going to take these 2 questions and then the lady in the final row. And there'll be drinks at 7 o'clock. Get the answers then from these guys. But if you could please introduce yourself and keep your questions really short, I'd be so grateful.
My name's Alwi Shale. I'm working on a project in emerging markets using tech and cryptocurrency. I was just wondering what role you think cryptocurrency can play in emerging markets. You know, when you look at fiat currencies, the average life expectancy is 27 years. Countries like South Sudan have inflation rates of 295%. I'm interested to know what you think of the role of cryptocurrency.
Thank you very much. And the gentleman behind you.
Yes, John Bishop, a Chatham House member. The Beijing model has been pretty successful in spite of some reservations over getting on for 4 decades. Is it still going to operate in the same way under President Xi, who seems to have a much more moralistic attitude in some ways than his predecessors, as instanced by his anti-corruption drive? Does this also extend to things like use of low-quality credit from secondary financial institutions and local government?
Thank you very much. And the final question.
Hi, Wei Ye from KPMG Macroeconomics. And my question is actually, how will the emerging markets crisis actually affect us in the developed world? Like, to give some examples, I was looking at the Fed stress testing scenario, and all it assumes is under severe stress, we've got 1% CPI and 0.1% interest rate. Is that going to be possible if we have like protectionism from the developed world, and as a result, emerging markets financial crisis? And also another example, emerging markets building up foreign reserves, as you mentioned, and this has been an important factor in driving down interest rates. Would we still have the same level of interest rate protection if we have emerging markets reducing their foreign reserves?
Thank you very much. Okay, so I think if we could just briefly, David, can I get you to address Wei's question?
Yes.
And then I think if I get the others just to pick up quickly on the others.
It's very interesting. I mean, the debt crisis, the Latin American debt crisis of the 1980s almost took down the US banking system. The exposure that US banks had in 1982 to Latin America was equal to around 250% of their capital. And the whole management of that crisis was effectively, certainly in the early years, designed to support the US banking system, because the consequences of losing the US banking system because of defaults in Latin America was just unthinkable for the world. It's not like that these days. The world's exposure to developing countries is much smaller in comparison to, you know, any measure of global finance. It's a much sort of smaller corner of the global asset allocation. So I wouldn't worry about crises in developing countries becoming some systemic problem for the financial system. But just one sec, on this very interesting point, about the effect of reserves holdings on interest rates. I think that's a very interesting question. In other words, the picture you're setting out is that if reserves fall and countries are selling their foreign exchange reserves, that puts upward pressure on interest rates and creates a kind of negative feedback loop. Very interesting point.
Thank you. Jinggu, the Beijing model under President Xi Jinping, is that going to change?
I don't think there's a Beijing model.
In that case, it'll change.
I think the most valuable lessons from China's development experience over the last 40 years is very much the ability to learn and adapt, and not just simply copy things. So that's the most valuable lessons from Chinese development experience. So there's no Beijing model, actually.
Okay. I'm not going to ask Robert to answer the cryptocurrency question unless you
Happy
want
to.
to. You are, you.
Okay,
All
no.
yours.
No. Just one footnote with regard to the future of the Beijing model. What we didn't get a chance to talk about is, of course, the viability of China's domestic financial system. The IMF sent out a note in December warning that addiction to debt and levels of debt had risen to such a level that comparisons with 2008 are now appropriate. That may be overblown, but there are questions about the long-term viability of a debt-driven infrastructure investment growth strategy as China has been playing it out. So that's that. Cryptocurrencies, I know next to nothing about cryptocurrencies, but I can tell you LSE has launched an online course on cryptocurrencies. So here's my answer.
With that, we are literally out of time, but I am on your behalf going to insist that the panel answer the question which is posed when you came this evening. Is there a new round of financial crises in emerging markets? Yes or no? David. Literally yes or no, because we're cutting into drinks now.
Okay. There's a difference between a sell-off and a crisis. In other words, currencies can fall in value, investors can lose money, countries go into recession. Those are all bad things that happen. But financial crisis is a very specific term, and I think a systemic financial crisis in emerging markets at the moment, I think, is unlikely.
Thank you. Jingle.
I think we have to differentiate the emerging markets. They are very different, so we cannot
China.
just. Yeah.
Will China have a financial crisis?
I don't think China will have financial crisis.
Thank you. Robert.
It's not here yet, but there's bound to be the next financial crisis. And I would bet my house on that. So.
Do you know, somebody told me that when you make a prediction, you should either make the prediction or give a timing. You notice he didn't give a timing, so Robert's going to be right at some point. And so will David, and so will Jingu. Please join me in thanking this fantastic panel for a wonderful discussion this evening. Please go and take a look at David's book. I think it's absolutely fantastic, and it's a good, sharp read. See you for drinks.